Good morning everyone, it's Guangzhou here. So today we will discuss about our initial coverage on CNMC Goldmine Holdings Limited. Now let's get started. So here is the company snapshot. CNMC was closed at around 53 cents on last Friday, and our target price is $1.03, which implies an upside potential of around 100% return. So here we compare the stock price with the SCI index and its underlying gold. The green line here is the SCI index, and the purple line here is the spot gold price. So we can see that CNMC stock price are more in line with the spot gold price. The next is the company background. CNMC is the first gold miner listed in SGX, and it is mainly engaged in gold production. So far, Soko Goldfield is the only mine that CNMC is exploring and mining. So there are 4 peaks located in this field: Maintenance Low, Hill Discovery, Sungai Katubon, and Recent. So as of December last year, the amount of gold contained gold resources is estimated to be 618,000 ounces compared to FY14's 506,000 ounces. Here are the investment thesis. So for mining companies, the underlying assets, the minerals, are the most important drivers for the business. So for CNMC, we will analyze on the physical gold market, the driver of the gold price, and why we think that the gold price will move up in the foreseeable future. So for the supply side of gold, there are 3 channels. Mine production dominates the major supply. You can see that over the past 10 years, the mine production supply is actually trending up regardless of the gold price. And for the scrap supply and net hedging, they are more influenced by the gold price. When the gold price was on the uptrend, the scrap gold supply is increasing, while on the gold price downtrend, it was decreasing. As far as the net hedging, it is the change in the physical gold market impacting by the mining companies' futures, forwards, and options position. So when the gold market is on the bullish trend, the mining companies will use financial instruments to defer their delivery at a higher price. While the price is on the downtrend, they will use that to lock in the price to avoid further downfall. So this is the demand side of gold. There are 4 major sources of demand. Using gold for jewelry is the main demand of gold. So you can see that the amount of demand for jewelry is quite stable and didn't move with the gold price. And for retail investments, the second largest demand for gold is increasing for the recent years. That is the common sense that when the gold price is increasing, the investment activities is actually trending up, so the demand for gold will increase as well. So for the net official sector, mainly for those central banks, after 08 subprime crisis, they started to increase the gold reserve in their treasury vaults. So that you can see that the demand for gold for net official sector changed from negative to positive. So for the industrial users, because of the higher gold price in recent years, they started to use substitute materials to for the gold usage. so that we can see that the industrial usage is decreasing. This is the supply and demand relationship compared with the gold price. You can see that generally supply over demand is quite usual in the physical gold market, and when the gold price is on the uptrend, the supply is more than the market will face more surplus, while when the gold price is on the downtrend, there will be less surplus and even deficit. So in a conclusion that we think that the supply demand is not the driver of the gold price, but the other way around, the gold price is actually impacted the supply and demand relationship. The next, we will analyze the major drivers of the gold price. So we think that money supply is the main driver to boost the gold price up. As we knew that after 08 subprime crisis, US conducted three rounds of QE, which is highlighted in gray here. And you can see the monetary basis increased exponentially. So the direct result of these 3 rounds of QE was that it inflated the asset price. So we can see, let's take equity market for example. The S&P 500 index increased substantially, and until the recent month in August this year, it reached all-time high level. So for gold, it met the all-time high level of $1,920 per ounce during the second round of QE. However, after that, the price started to fall. And one of the explanations could be that the investors, they shift the capitals originally invested in gold to equity market or bond market to gain higher yield. So like US, other major economies, they gradually join the QE camp. Here we'll combine the 5 major central banks: the Federal Reserve, People's Bank of China, Bank of Japan, European Central Bank, Swiss National Bank, because we think that the balance sheet of the central bank is a proxy of their monetary policy. If the balance sheet is increasing, that means they are conducting the expansional monetary policy. So you can see the chart here. Before the end of 2012, the gold price movement was quite matched with the increment of the balance sheet of these central banks. However, it started to decrease after end of 12. Now let's take a look at the gold reserve growth rate for these central banks. Let's see the bar chart below. So over the 10 years, the total amount of these 5 central banks gold reserve only increased by 6.4%, and this growth rate is much lesser than the growth of their balance sheet. So the theory behind this was that the supply of fiat currencies outpaced the stock of gold. The gold price should rise. So in a conclusion that the gold price is currently suppressed, and we think that the gold price will move up in the future. The next, we will talk about the signs of recessions, so for this technical point of view, we derived from our TA report, which published 2 weeks ago. We will go over it very quickly. The first chart is the US GDP year-on-year growth. When the growth rate approached to 1% or drop below, it will foresee a recession is coming. The next is industrial production year-on-year growth. When the growth rate drop below zero, there will be 73% of the probability that recession is coming. The next one is the unemployment rate turning point. So when the rate tick up above the 12-month moving average and form a bottom, we will foresee that the recession will start. So here is the summary of the gold performance during the past 6 recessions. So we can you can see that the average return of the gold price during recessions is around 22%. So in a nutshell, we think that the over amount of money supply, together with the sign of recessions, we will see that the gold price will have a big move up in the foreseeable future. The next is the investment merits. We'll talk about the fundamentals of CNMC, such as the reserve and resources, the capacity which the company just ramp up, and why the CNMC enjoy high profit margin, and the catalyst that can boost the price up in the upcoming years. Now here we need to explain a bit. So reserves and mineral resources are two different concepts. Reserve is part of the resources that are economically and technically feasible to extract, while the resources is not currently economical to extract, but have the prospect for the eventual economic extraction. So when I know that investors will concern much on the amount of reserve and resources, but we think that we need to focus on the trend of those reserve and resources. You can see that all these 3 peaks, the total amount of reserve and resources are actually on the uptrend, which means that the company is has been discovering new amount of gold minerals. And look at the bar chart here. So there are 3 levels of gold minerals: measured gold, indicated, and inferred gold. Measured gold means that it has the highest confidence that the mineral resources can be converted to reserves, while the inferred gold has the lowest confidence that the resources can be converted to reserve, and the indicated gold is in between of these 2 levels. So generally, you can see the total amount of these 3 types of gold. You can see that over these 4 years, over these 5 years, the total amount of these resources is increasing. That means the amount that CNMC explore or discover each year is more than the amount that CNMC extracted or monetized. So we can see that currently CNMC's gold mine is on the production phase. The next is the capacity. So in April this year, the company ramped up another 200,000 tons, together with the previous 1 million tons of ore processing capacity. The total current minimum capacity reached 1.2 million tons. So you can see the production statistic here. Last year, the actual ore processing capacity, the actual maximum ore tons processed reached to over 1 million tons, and this is only within the recent peak. And also in June this year, the company received the approval of large-scale operation for so-called project. So with this approval, the company can mine unlimited amount of ores with the license, which is extended to 2034, which is around 18 years from now. The next is about all-in cost. CNMC has the has the significant low all-in cost compared to the peers within the industry. So there are 4 major reasons. One is the open pit mining. So open pit compared to underground pit, it has pros and cons. The pros is that open pit is subject to lower mining costs, but the gold grade is lower than the underground pit. The next is the mining schedule. So according to the management, they will prioritize the mining in heap leach sources like Rickson and then new discovery. They will put the carbon in leach processing at the later stage of the mining schedule. Because the heap leach sources has the lower mining costs as compared to carbon in leach. That's why their all-in cost is low currently. The next is the workforce. Besides their blasting fleet and the exploration fleet that is outsourced to the third party, all the mining fleet and the administrative staff are all in-house employees. So throughout this, the companies is able to reduce the labor cost expenditure. Lastly, they will the company will order the leaching chemicals directly from China rather to procure within the local Malaysia market. So this can reduce the expenditure on the raw materials. So we can here is the look at the line chart here. Here's the comparison with the here is the comparison of the gold price and the all-in cost. So the recent quarters, CNMC is able they are managed to control the all-in cost within the level of $500 per ounces, so that they can have a higher all-in margin. So in the latest quarter, the second quarter of this year, the all-in margin reached 60%. And overall, the average of this all-in margin is around 50%. The next is the other minerals underground that yet CNMC hasn't extracted it and monetized it. So back to the questions, how many golds that CNMC can extract? The answer is that this table is derived from the annual FY15's annual report. So by the year end of last year, the total amount of contained gold attributable to CNMC is around 500,000 ounces. But this number, they will update it each year. So for other minerals like silver, lead, and zinc, which are concentrated at Manson's Low Peak, the value of these minerals hasn't been priced into the valuation of the current price. The next is the catalyst of Pulai project. So in June this year, CNMC announced that they acquire 51 stake of interest of the Pulai mining. So according to the disclosure, Pulai has the similar mineralization features as the so-called Goldmine, which is we can assume that Pulai gold field is an open pit, so it will subject to lower mining costs, and the size of this field is 3 times more than the current one, and also the Pulai field contain iron ore resources around 10,000 tons of which were extracted with the grade ranging from 50% to 55%. Next is our key assumptions on CNMC. So there are two major components for the top line: the production volume and the gold price. And we derive our gold price from Bloomberg based on market consensus. You can see here. So for the production volume, we use the Porrecta capacity given use the Porrecta capacity to calculate the production volume given the implied gold grade is maintained at last year's level. So the line chart below is the estimated all-in cost for this year and next 2 years. So the surge of this year's all-in cost is due to the payment for the extension of the license. The amount is about US 4.9 million US dollars. So since 2013, CNMC has started to generate significant cash flow. We use FCFE to value the stock price, and our cost of equity is 9.8% because we incorporate the risk of the mining business. And so far, Soko Goldfield is the only gold mine, so our sustainable growth rate is 0. So our target price is $1.03. Here are the investment risks. Basically, all these risks are from the major components of the top line: the gold price, gold grade, and capacity. So if all these components has a positive increment, it will pull up the revenue. While when these components have a negative decrease, it will pressurize on the net profit margin. Here is the peer comparison table. So we can see that CNMC now is trading at around 11 times of PE compared to the average of compared to the peers average of around 59. Here the peers we use the Asia developing countries gold mining companies as the peers. So based on our target price, the PE target could reach around 22 times. So this is the recap of CNMC. Our target price is $1.03, and some investors may ask about the the CNMC stock price sensitivity compared to the gold price. We can see that year to date the gold price went up from 1,100 to the current around 1,300 to $200 up while the stock price went up from less than 20 cents to the current 53 cents, more than double the more than double the original price. So investing in gold mining business is like an leverage investment that can let you expose to gold market. So this is the end of our presentation. Any questions? So there is a question asking about what will be the impact that if Federal Reserve decides to hike the rate this week. So the gold price will probably falls if the interest rate goes up. Another question is asking about what will drive the current price higher. So as we say that the drivers could be the gold price. Another one is the capacity if the company can manage to produce more, can increase their gold production, uh, which to generate more profit, given the current low oil costs can be maintained. So the price will move up. So looking forward, another catalyst is the Pulai project, which the deal is still under negotiation. So once the deal is sealed, we can see more positive synergies from the acquisition. There is a question asking about the reason that the stock dropped so much before it uh, raises so rapidly, because back to that time uh, it, it is subject to a trading halt due to the application for the large scale operation. So after that they got the approval, the price shoot up again. And our target price is for next 12 months, yes, correct. So there is a question asking about the probability that the Fed will hike the rate in September. You can see the screen here. So in September, the probability is around 20%, and in November is around 28.6%, and December is around 55%. So the questions is about only 20% of the probability that the Fed will hike the rate in September, and why the gold price dropped so much. So use the recent peak as the benchmark. The gold price only dropped like 4 to 4% over. So that was because the investors may expect the Fed will hike the rate at least once within this year. And so far, the uncertainty of the U.S. election probably will drive the investors to let the investors hold the positions on gold. So if there is no questions here, we will end our webinar today. Thank you for tuning in. We will see you on next Monday.